Hey everyone, welcome back to Corporate Decoder, the place where we take a magnifying glass to the financial secrets of big companies and spill all the tea. Today we're diving into PreAxia Healthcare Payment Systems Inc., a company that is filed for an amendment to its quarterly report, and let me tell you there are some very interesting changes here that shed light on its financial twists and turns. Get ready because this is not your average financial read. So PreAxia Healthcare Payment Systems Inc. has filed an amendment to its previous report. Think of it like a correction or an update to a story they already told. The main reason for this update is to fix some numbers on the cover page about how many shares of their stock were out there, and also to clarify some events that happened after the main reporting period. It seems like they're fine-tuning the narrative about their financial status. Now let's get to the core of what this amendment is all about. They're specifically correcting the number of outstanding shares as of the 15th of October 2025 to 54,314,782. That is a significant number. They're also clarifying that shares of stock were issued to settle stock subscriptions from the last quarter amounting to 34,547,084. This is crucial because it shows how they are managing their commitments and converting debt or agreements into actual shares. It's like a big reshuffle of who owns what in the company. Let's look at the balance sheets from the 31st of August 2025 and May 31, 2025. The first thing that jumps out is the total assets. For the 31st of August 2025, it is 115,020.85, whereas for May 31, 2025, it is 0. This jump to over $1 million in assets is massive. Where did all this come from? It seems like cash equivalents and prepaid expenses have significantly increased. This often indicates new funding or a change in how they value their assets. Now let's talk about the shareholders' equity or deficit. On the 31st of August 2025, it is 427,322, which is positive. But on May 31, 2025, it is a negative 2,341,169. This swing from a big deficit to a positive number typically means the company has either brought in a lot of new money through equity or converted a lot of debt into equity. It is a sign of financial restructuring. Moving over to the income statement for the 3 months ending the 31st of August 2025 and 2024, we see zero revenue in both periods. This means the company is not generating sales from its core business yet. However, look at the operating expenses. For the 3 months ending the 31st of August 2025, it is 875,203. Compare that to just 4,627 in the same period in 2024. That is a huge jump in expenses. This increase is driven by consulting, research and development, and management and labor costs. Essentially, they are spending a lot more money this year on developing their products and services. And with no revenue and high expenses, it is no surprise that the net loss for the 3 months ending the 31st of August 2025 is 875,134. This is a big jump from the 4,627 loss in the prior year. They are spending heavily to build the future of the company. Following that, the net comprehensive loss is also substantial at 874,906 for the recent period. This shows the overall financial hit the company is taking while it is in its development phase. Let's look at the changes in shareholders' equity. On the 31st of August 2024, the equity was a negative 2,400,806. Now fast forward to the 31st of August 2025 and the equity is 427,322. What caused this dramatic shift? It's the significant increase in stock subscription issued for cash, stock subscription issued for services, and stock subscription issued for debt. These entries show a lot of new financial activity happening through stock subscriptions. Specifically, the subscription for stock to be issued line item shows a big increase from 7,825 in May 2025 to 3,651,222 in August 2025. This number represents agreements where investors have committed to buy stock but haven't fully paid or received the shares yet. This is a clear indicator of upcoming equity funding. Now for the cash flow statement for the 3 months ended the 31st of August 2025. They used 74,801 of cash in operations. This might seem like a lot, but it is offset by 780,000 in subscriptions issued for services. So while the core business is using cash, the influx of capital through these subscriptions is keeping them afloat and even boosting their cash position indirectly. Compare this to the previous year where they used only 2396. A much larger scale of operations and investment is happening now. The financing activities are where things get really interesting. For the 3 months ending the 31st of August 2025, they had 204,858 from financing activities. This includes 200,000 from stock subscriptions for stock to be issued. This is direct evidence of them raising capital by selling future shares. In the prior year, financing activities only brought in 2383. So this is a massive acceleration in their fundraising efforts. Under non-cash investing and financing activities, we see stock subscription issued for debt for 1,643,397 and stock subscriptions issued for prepaid assets for 1,650,000. This is huge. It means they are converting debt and other obligations into stock subscriptions. This is a common strategy for companies in early stages to reduce debt and strengthen their equity base. The company itself was incorporated back in 2000 in Nevada. Back in 2005, they acquired Tiempo de Mexico Limited. The main goal today is to develop and sell healthcare payment processing services and personal financial management tools. They are also creating new subsidiaries in Canada and the US to push these products. It is clear they are building a business for the future in the fintech and health tech space. Now, here is a big one. The company itself states that there is substantial doubt about its ability to continue as a going concern within 1 year. This is a serious statement. It means that based on their current financial situation, including their net comprehensive loss and cash used in operations, there is a real question about whether they can stay in business without new funding or a significant change in operations. They explicitly mention needing to develop additional sources of capital and achieve profitable operations. This statement really drives home the point that the company's survival hinges on future funding and success. Right now, they don't have enough cash or revenue to cover costs. They're relying on company officers and principal shareholders to provide funds for basic costs. They are hoping to attract investors, but there is no guarantee. If they don't get this financing, they may have to scale back or even shut down operations. An interesting detail here is how they handle different currencies. Since they have operations in Canada, their functional currency is the Canadian dollar for their subsidiaries, while the main company uses the US dollar. They translate these foreign currency assets and liabilities into US dollars using specific exchange rates. The fluctuations in these exchange rates are also accounted for in their financial reports. For instance, they mention exchange differences of 228 for the period ending the 31st of August 2025. Let's talk about earnings per S-Hair. For the period ending the 31st of August 2025, they have 34,527,007 shares of potential common stock equivalents like subscriptions for convertible notes. However, these are not included in the earnings. Per S-Hair calculation, because they would actually make the loss per S-Hair look better, which is called being anti-dilutive. This means the actual potential dilution from these instruments is so large that including them would make the reported loss per S-Hair appear smaller than it really is if the company were profitable. The company is investing heavily in research and development. For the 3 months ending the 31st of August 2025, they incurred $391,263 in R&D expenses. This is a significant amount, especially since they had zero R&D expenses in the same period last year. They are developing personal financial management tools and have even reclassified some contract labor office expenses and management contract costs into R&D. It shows a strong commitment to innovation. They have recorded significant prepaid expenses, including around $1,800,000 in stock subscriptions for consulting and management services. These are expenses paid in advance. They are amortized over time. What is interesting is that the company recognized stock-based compensation on grant dates for a portion of these subscriptions and are recording the rest as prepaid expenses to be recognized over the next 36 months. This means they are accounting for future services the company will receive as an asset now. This section is always a good place to look for insider activity. Pavel Bondarev joined as a director shareholder and related party on the 30th of June 2025. Both Tom Zapatinas, the CEO, and Pavel Bondarev have employment agreements. As of the 31st of August 2025, there are significant accrued officer compensations to both of them. Tom received $420,000 and Pavel $12,661. Additionally, Tom received consulting fees and Pavel management services. There are also related party loans and promissory notes which were converted to stock subscriptions. This shows a lot of financial dealings between the company and its key personnel. Let's look closer at the common stock. As of the 31st of August 2025, they had 19,767,698 shares issued and outstanding. They also issued stock subscriptions for quite a lot of shares for things like independent contractor agreements, consulting services, and to convert debt. Notably, many of these shares were not formally issued until October 2025, but their value was recognized as of the grant date. This is a common practice to acknowledge agreements before the formal issuance. They also had a private placement in August 2025 receiving $200,000 for 800,000 shares. The company identifies itself as operating in one segment, but 2 locations, Canada and the US. They have no revenues but substantial expenses in both. Canadian expenses were $403,208 for the period compared to just $21,227 the previous year. US expenses were $471,698 compared to $2,500. The significant increase in expenses in both locations reflects their expanding operations and investment in development. This section tells us what happened after the main reporting period. In September 2025, they created a new US subsidiary, Zane Inc. They also decided to operate under the name PreAxia's Zane Financial. More importantly, on the 3rd of October 2025, they converted $117,820 in debt into 491,314 shares of common stock. And by the 15th of October 2025, a massive 34,547,084 shares were issued to settle stock subscriptions. This confirms the huge equity and debt to equity transactions happening and their impact on ownership. Now we get into management's own perspective. They acknowledge the risks and uncertainties involved, including economic conditions, competition, and their ability to attract and retain talent. They are very clear that they may not achieve future results and caution investors against placing undue reliance on forward-looking statements. This is standard practice, but it emphasizes that the company operates in a high uncertainty environment. Under the general overview, they reiterate their business objective, developing and selling payment processing services and financial management tools. They highlight the growing HSA market and the shift towards consumer-directed healthcare. They plan to raise more capital, penetrate markets in Canada, the US, and worldwide, build strategic alliances, and fill key management positions. This is where the going concern issue is further elaborated. Their cash balance was $130,285 as of the 31st of August 2025 compared to zero previously. However, they had a working capital deficit of $232,678. They openly state that their cash is not enough to meet requirements for the next 12 months. They project needing an estimated $1 million for creditors and to complete their business plan. They plan to raise this through private placements or loans. This is stark. They are in a critical funding phase. Here is a clear look at their working capital. A deficit of $232,678 on the 31st of August 2025 compared to a much larger deficit of $2,341,169 on May 31, 2025. The improvement is due to debt conversion, stock sales, and subscriptions. This is a very positive sign that they are actively managing their short-term financial health through these transactions. Looking at the results of operations, there is no revenue, which we've seen, but the expenses are up dramatically. Consulting fees, research and development, and management costs have all surged. This is the cost of building out their business and products. It's worth noting the breakdown of labor costs. Tom Zapatinas, the CEO, earned $30,000 for consulting services. Pavel Bondares, a director, earned $20,000 for management services, and also received a stock subscription worth $660,000. These figures highlight how key personnel are compensated and involved in the company's growth. Now for some really important internal housekeeping. The Chief Executive Officer and Chief Financial Officer concluded that the company's disclosure controls and procedures were not effective as of the 31st of August 2025. This means that the systems they have in place to ensure that all required information is properly recorded, processed, and reported are not working as well as they should. While they claim there have been no changes in internal controls over financial reporting that would materially affect them, it is still a red flag when a company admits its disclosure controls aren't effective. This can lead to errors in reporting or even overlooking important information. On cybersecurity, they're fairly transparent. They admit they haven't maintained current customer lists or sensitive data yet, but they plan to create procedures to manage cybersecurity risks in the upcoming year. One could argue this is responsible a company this early in its development doesn't have much to steal yet, but it also means they need to be very careful as they grow and start handling more sensitive information. Finally, we have the list of exhibits. These are the supporting documents for the filing. Most of them are historical agreements and company formation documents. What is interesting is that there are specific certifications filed by the CEO and CFO for Sarbanes-Oxley compliance. This shows that despite some control weaknesses, they are still adhering to important corporate governance rules. The XBRL documents are there for electronic data tagging, which is standard for SEC filings. So what is the story here with PreAxia Healthcare Payment Systems Inc? Well, it is a company in intense development mode. They are spending heavily on R&D talent and operations, burning through cash, but also actively securing future capital through equity financing and debt conversions. The massive increase in stock subscriptions and the conversion of debt into equity are the main drivers of their financial transformation right now. However, the admission of ineffective disclosure controls and the serious going concern warning are significant red flags. They are in a race against time to secure substantial funding and achieve profitability. The substantial debt to equity conversion is a bold move likely to appease creditors, but it also means a lot more shares are out there potentially diluting existing shareholders if successful. The future of PreAxia hinges entirely on their ability to successfully execute their business plan and attract more investment. Their success will ultimately depend on whether their innovative healthcare payment processing and financial management tools gain market traction and start generating revenue. It is a high-risk, high-reward scenario. Alright, that's our deep dive into PreAxia Healthcare Payment Systems Inc. latest filing. What do you think about their aggressive development strategy and the significant financial maneuvers they are making? Let us know your thoughts in the comments below. If you found this breakdown useful, hitting that like button really helps us out. Subscribe for more corporate deep dives. And don't forget to check out our Discord community linked in the description for more real-time discussions. Thanks for watching, and see you next time on Corporate Decoder.